Well, welcome. Love this room. Great visibility, great view. So if you get bored, you have a nice view to look at. Thanks for your interest and thanks for coming to our shareholder seminar. We thought we'll do this year something slightly different, something a little bit more interactive around the table, and give you a market update on private equity in general, enterprise trust. But we also are very excited to pick up two very specific topics. One is Mark. We'll talk about my colleague Mark from ICG. He is one of the senior executives of the private credit team. We'll talk about private credit and the financing markets and private equity. So I thought that was particularly addressing questions around capital, cost of capital, and how big the refinancing risk is within private credit, within private equity. So Mark will dive deep into that topic. So we're very excited about that. And then I will talk about secondaries because that's also a key focus of a lot of the meetings we've had with shareholders. So we thought those are two topics where it makes sense to kind of dive more deeply. I'm also joined by my two colleagues, Lisa and Colin, who will discuss more about the enterprise trust, where we are, our strategy at work. And then our chair, Jane, will give an introduction. A couple of housekeeping things before we kick it off. We'd like to do this interactive usually, but because we're doing a hybrid, we have people online. What we would like to do is go through the presentations pretty quickly. There's a lot of content. We'll try to get it through within 1 hour and then have a Q&A for everybody open so that also online our investors and people who are participating online can join us. With that, I will let's start off with the first slide. Have a book all in front of you. I just want to talk a bit quickly about the key takeaways before we start with Jane's introductions. And I'd like to highlight 5 key takeaways, which hopefully during the presentation, as we're diving a little bit deeper in those topics, you will come away with understanding how we feel about private equity. And first of all, that we have a very differentiated investment team, differentiated investment strategy, but most importantly, that we have a dedicated investment team, which really helps us to construct a portfolio. And we'll talk about that in a second. Our goal is to provide compounding growth for our investors in a very consistent and constant way. Having that kind of dedicated investment team allows us really to construct that portfolio, which gets us to the second point. So our operational performance we're very quite happy with the portfolio we've picked, and we'll share some data with that. Mark will talk about the debt markets, but the good news is it looks like debt and the cost of capital is peaking, and we're starting to see actually that the pricing is reducing. I hope you'll see that the benefits from the ICG platform is flowing through the quality and types of companies and the types of deals we do. And then lastly, that our board has been very focused, very active and deliberate in the approach to kind of generate shareholder value in an environment, as we all know, we're frustrated with the discounts and we think it's quite anomalous. And so quite happy to see the board being quite active about that. But with that, I'll hand it over to Jane.
Thank you.
To give her introductory remarks.
Well, thank you all very much, Karen. Many familiar faces, so thank you. So what's the opportunity I see here? We've got a portfolio of companies that typically are between $500 million and $1 billion in size, so that they're in a sweet spot in terms of ability to grow from here. They are mature businesses, profitable, cash generative. They're often mission critical, very healthy margins, and they've got good pricing power. So it's a portfolio that's one. The opportunity to compound returns from here is great, and the board focus on obviously compounding returns over the long term. And we've done 14.6% annualized NAV over the last 5 years. So compounded returns are a priority, but distribution is also important to us. And we and the manager think this can be done without hindering the returns. Our distribution is focused on three things. There's the progressive dividend policy, which we've been doing since 2017. In the last 5 years, we've increased by nearly 10%. There's the ongoing buyback, which is effectively day in, day out money with Numis, so they can facilitate that market and be a buyer for that. And it's useful for mopping up our savings scheme, DRIP. And the third is that we've instigated recently, which is the opportunistic buyback, which we put 25 million this year towards. We've used 7 million of that already. And that is really us, the managers, it's an opportunity for us to make some money. Shows our confidence in our NAV and seeing the discounts as an opportunity. So that's where we focus. Compounded returns, distributions, and the discipline that those distributions give. And I'll hand over to the team now. But before I do hand over to the team, I want to reinforce to you all how ICG. I joined in 2019, and as you know, it was graphite before ICG. ICG have really put money on the table to back this fund. The team has huge depth of knowledge and experience. They've also capped their fees. This is the first full year we've had of it, and so just under £2 million on it. They've taken the vast bulk of the sales and marketing budget. So we've had huge commitment from our manager for this fund. So that over to the team.
Thank you, Jane. Why don't we kick off the presentation to put some context behind private equity on page 8. Put a broader context there. We put the slide together just to kind of step back and why is private equity performing so well, and what are the kind of key ingredients here in terms of the underlying performance. And maybe I thought I'd share a short story about my background and why I came actually to private equity. I used to, many people probably don't know this, but in 1994, I bought a company out of bankruptcy because the company was bankrupt, needed no money. In my youthful exuberance, I thought I could easily turn around this company. I went through 2 or 3 years of very difficult times, but managed then to actually create a market share leader in the US. We were doing aircraft galley equipment, which is a fancy word for trolleys for the beverage and for the food. And as you can imagine, there was a lot of wear and tear on those. And so make a long story short, after year 3, 4, I managed to became the market share leader in the US and had about 70, 80% market share. And we were growing very fast, big orders coming in. But I had no capital. I had no working capital. I couldn't finance the growth. I went out, no banks would finance me. Private credit market didn't exist. Private equity market hardly existed. So it was very difficult for me to capital. My biggest competitor was private equity backed. And so I sold my company to a private equity backed company because they had the growth, they had the capital, they were able, and they had the expertise to help the team to kind of build the business. So that's where I decided that this makes a lot of sense. And there is a great market here. So I set up in 96, 97, a private equity business together with an old friend of mine from business school. And then I think why I'm telling you the story is because what private equity brings to the economy is exactly what happened to me then. And I think that is fundamentally the key driver of returns, is transforming good companies to better companies. And that's why, and this value creation, as you see here on the slide, comes from many ways. Some firms are better in certain areas, some firms are better in other areas, but it's not all about cost cutting and leverage. It's really about value creation. And as you see here on the middle part of the slide, the job creation in the private equity market far exceeds what you see in the in the overall average growth in the European economy. And I think the other important message from the slide is we have to always constantly understand that 80% or close to 90% of the US economy of companies above 100 million are actually private. So in order to access the real economy, you really need to be in the private markets, and the public markets are becoming less and less really representative of the economy. And I think the big institutional investors recognize that. So as you see on the next slide, the allocation to private equity has dramatically increased over the last 10 years, 15 years. And that's really for two reasons. One is because of the superior returns, but also getting access to the real growing economy. And some of the most sophisticated investors, such as GIC, New York State, CalPERS, they continue to increase the allocation to private equity. So they still believe that despite a lot of people saying because the cost of capital has changed, private equity is going to be more difficult. They actually, big sophisticated investors actually think differently. They continue to increase the allocation. The other interesting development in the private equity market is, and you probably picked this up, that in particular in the US, there's a big trend to offer private equity to the private wealth platform. So you see an emergence of a lot of what they call it semi-liquid funds or RIC 40 Act, by the RIC 40 Act. So you see Blackstone, Apollo, all the big private market asset management firms offering those kind of semi-liquid products. And it's a huge trend in the private equity market. And the irony is that here in England, the trusts have actually performed and have actually, put a structure together, which is 100 years old, which addresses the liquidity and the ability for the wealth or private investors to access private equity. So therefore, you would think that at some point in time, people recognize this, that this is actually a superior structure over the semi-liquid structure. So we're hoping that some of that flow and some of that excitement we're seeing in the semi-liquid structures, people start to all realize and find interest also in the trust structure. If you go on to the next slide, some of the headwinds we've had over the last to address some of the headwinds and discuss some of the headwinds we've seen over the last couple of years. It has been a very challenging fundraising environment. And the reason for that is there was less liquidity coming back out of the private equity portfolios. So the investors were a bit stuck. Plus, there was a denominator impact where the public market assets dropped significantly in value and people were over allocated to private equity. So there was a lot of, it was quite a challenging environment, which for us actually was, as an investor into funds, was actually quite helpful because that widened our already pretty good access or very good access to private equity. So particularly Lisa and Colin have done a fantastic job getting us into managers where they have been oversubscribed for many, many years. And we were one of 3 or 4 new investors coming into the funds. So that, such as like a Thoma Bravo or Genstar. So that has been helpful for us. The slowdown in deal activity is obviously has been a struggle and a challenge for private equity investors as a lot of capital has been kind of built up or dry and there's not the valuations had to be addressed and adjust from a peak in 21, 22. However, for us, it actually worked out quite well because of the challenging fundraising environment. We were able to come alongside some of the bigger managers and find some interesting deal opportunities. So we picked some good companies, I think, or we'll talk about that in a second. Certainly picked some very interesting businesses. You see that realizations have been significantly down over the last, and we've been impacted by that too. Typically, our realizations are somewhere around the low 20s as a percentage of NAV. Last year, we were at 12 to 13%, and the industry average was around 9%. So a significantly drop in realizations. However, we feel good about that. We have a portfolio still attracts sales and exits, and that's why we were above our peers. But what has been missing for us are the top 10 exits or the top 30 exits, big event exits. Despite that, we had enough flow through the portfolio that we were getting 13%, so it was ticking over. That environment has improved, not dramatically, but definitely improved over the last year. So we're expecting a better result out of the top 10 or top 30 assets being exited in the next 12 months. The next slide, many of you have already seen this slides. I will go very quickly through. What is our goal for our investors is to really, well, let me step back. As you know, private equity long-term has been the best performing asset class. However, private equity has two issues. One is the illiquidity, and the second one is the risk. Particularly when you look at from the dispersion between the bottom quartile funds and the, top quartile funds to the bottom quartile funds. And that dispersion is bigger than in any other asset class. So our investment strategy is really designed to provide private equity type of returns, but with better liquidity and much less risk. And the way how we do that is really about this slide. It's really kind of describes well over our investment strategy. So we're very focused on preserving private equity returns, but taking risk out of the portfolio. How we take risk out is the first three columns. We only do buyouts because they have much lower loss ratios. We only do developed markets because that's where the deep expertise sits and where the best liquidity is, US and Europe only. And we do mid-market to large deals because that's where the fund manager have the resources to transform companies, but have not gone too big where you get some organizational challenges or putting capital to work. We have some exceptions in that area, but in general, that's where we would like to live, in the mid to large market. How do we drive returns? It's really making sure we have access to the best managers. As we said, top quartile, if you get access to the top tier funds, you can really outperform. And then we overlay the selection around picking defensive growth companies and managers who have in their strategy, we can see the defensive growth selection in their funds. And that's kind of how we try to provide you with a portfolio of compounding growth with higher liquidity and much less risk. Maybe a couple of words on defensive growth. Everybody, you will hear that word a lot today. What does that actually mean? What that means is we're looking for companies, sectors, fund managers who have the ability to pick companies or find companies who perform well in good times as well as in bad times. And some of the key selection criteria you see here on this page. So these are companies we're looking for who have either have a strong market position, have mission critical services, pass on price increases, and have high margins. And you'll see some of the examples here. Maybe we have covered many of those companies in past presentations. Maybe just a couple of words on some of our newer investments like Ping Identity. Ping Identity is a Thoma Bravo investment. We co-invest alongside Thoma Bravo, is one of the leading cybersecurity companies. What they do is they provide access management and identity management. So many of you probably don't realize they are actually constantly using this every day. So when you go into a website or an app and you get a text message back or an email with a code to dial into or get access to your files or servers, that is usually done by Ping Identity or there. This is a market very much driven. Ping is the one out of two pure players in that market. Credible company has been growing EBITDA the last 12 months by 50%. We were able to buy this business at a substantial lower valuation than, for example, the HG portfolio is traded on an average, growing very strongly. And the base case is at a valuation of 17 times EBITDA, which is significantly less than what we've seen in the market for cybersecurity companies. So we feel really, we're very excited about this business, and it's performing well. Then we've bought a business co-investment in a business in 2021, 2022 called Newton, alongside the ICG Middle Market Fund. What they do is operational improvement consulting. What that means is they go into big companies, particularly into public services or in the public industry, public sector. So, for example, the English Defence Ministry, and help automating and designing processes to be more efficient. And what's unique about them is they actually go in and sell themselves how much savings, how much improvement efficiency they can bring in, quantify it, and their fees and their profit is basically dependent on the performance of that and the ability to deliver on that. So it's a highly performance-based model, which makes them very unique and obviously very popular. The LTM growth in revenue was 41% last year, the last 10 to 12 months, and the EBITDA grew 42%. And in addition to that, we have a downside protection security in here. This is a pref equity, so we're sitting on the right after the debt above management and other investors. So has been a very nice business, picked and found by our colleagues at ICG in the ICG Middle Market Fund. The last slide I'd like to kind of cover is really about giving you another view and a perspective on the portfolio. What we've done here is we've taken the rolling 5-year average EBITDA growth of our portfolio, of our top 30, which represent about 50%, 40 to 50% of the total portfolio, and compared it to the ICG European Private Company Index. So ICG, Nick Brooks kind of leads that effort, has a database put together over the last 10, 15 years and compiles the data on 1,500 private companies in Europe. And then we compared it to the FTSE All-Share EBITDA growth. And you'll see here that our portfolio has performed that in general, private companies have outperformed in terms of growth vis-a-vis the FTSE. But we have even outperformed the European private companies by selecting, and these are the top 30. So most of these companies, with the exception of one, I think, are selected by us and the investment team through the co-investment program we do alongside our fund managers. Why did we do the rolling 5-year average? Because there's some distortion, obviously, when you look at from COVID, 20 years between 20 and 22 are quite distorted. So that's why we took the 5-year average to kind of get the best reflection of that data. Now, talking more about the portfolio and more about our investment strategy, I'll hand over to Colin and Lisa. Oh, sorry. It's Mark first. Sorry about that. Mark, you're next.
Thank you very much, Oliver. Good morning, everyone. By way of a very quick introduction, my name is Mark Richmond. I'm a managing director in ICG's private credit strategy, which we call Senior Debt Partners, which has been providing predominantly senior secured debt to private equity-backed companies since 2012. To set the scene, I'll quickly highlight the main value creation levers in a leverage buyout. So on the left-hand side of the page, revenue growth, margin improvement, multiple expansion, and financial leverage. And for the remainder of my slides, I'll focus on the latter. I think the ability to put an appropriate, sustainable capital structure on a company is a key driver of success for private equity. It is our responsibility as a lender also, working side by side with private equity, to do the same. Turning on to slide 16, while the graph on the left is illustrative, it highlights the multiple potential sources of debt in a buyout. If we think about the last couple of years, we've seen a continuing retrenchment from banks due to regulatory pressures on bank balance sheets. The public markets have reopened. So I'm talking about the term loan B, leverage loan market, and all high yield bond market, which closed post Russia-Ukraine. But private credit has continued to take share overall. I think one clear difference between the GFC and the Russia-Ukraine situation is that private credit was able to step in to support borrowers this time around when the public markets were shut, which is clearly a positive structural shift. Moving on to slide 17, I'll just quickly take you through some high-level debt market perspectives before going into a bit more detail on each. But the key messages that I'd like you to take away today are clearly, firstly, both public and private credit options are currently available to borrowers, so debt is freely available. The increased competition between the two markets, as well as other technical factors, is bringing down the cost of debt. Credit quality remains high. So while we've had higher financing costs in the last couple of years, these have been addressed by a reduction in leverage and higher equity checks, while underlying credits continue to perform. And finally, with the wave of repricing activity that I'll come to and proactive maturity extensions, refinancing risk has been reduced and default rates remain low. Moving on to slide 18, the availability of debt from public markets is clearly increasing. The right-hand side of the page, you can see that in Europe, for example, in Q1 2024, we've seen over 20 billion of new CLO issuance, well ahead of prior year. And absent that material M&A volumes, this has enabled borrowers to extend maturities, thereby reducing refinancing risk. Slide 19, coming to Oliver's other point, debt pricing is also coming down. So an improving technical backdrop has seen spreads tightening in the leveraged loan and high yield markets in both Europe and US. We continue to see demand for opportunistic transactions, such as maturity extensions of 2 to 3 years and downward repricings of 75 to 100 basis points in the public markets. And this trend has continued well into Q2. On slide 20, just to talk through private credit, which has increased through cycle availability of debt. Deals under 300 million now account for a very small proportion of leverage loan and high yield issuance in the public markets. As mentioned earlier, one of the key differences between the GFC and the Russia-Ukraine situation is that private credit was able to step in when banks retrenched and the public markets were closed. Moving forward to today, competition from the broadly syndicated market and high levels of private credit dry powder has seen tightening in direct lending also. Moving on to slide 21. The higher financing costs over the last couple of years have clearly been addressed by a reduction in leverage and higher equity checks, which you can see in both Europe and the US on the two graphs. According to Deloitte, sponsors have continued to focus on resilient and cash generative credits in 2023, with TMT, business services, healthcare and financial services accounting for nearly 70% of all deals in Europe, for example. Leverage across these sectors in 2023 versus 2022 declined by half a turn year on year on average. On slide 22, while looking ahead, base rates are likely to remain higher for longer. Strong balance sheets leave corporates well positioned as the cost of capital comes down. On the left, just wanted to highlight also that GFC default rates show that PE-backed companies were more resilient than non-sponsored companies. In the current environment, the surplus of private equity dry powder should also lead to lower defaults as sponsors look to protect their equity. The chart on the right shows that leverage and interest cover metrics remain healthy and stronger than pre-GFC also. So how do our teams work together, and how does ICG Enterprise Trust benefit from having in-house debt experience? I'll talk to the left-hand side of the page before handing over to Con. So ICG Senior Debt Partners, where I sit, is the largest European direct lender focused purely on senior secured debt. We launched the strategy in 2012 and have raised 4 vintages to date, with a fifth about to close. Given our size and our ability to provide loans of 100 to 800 million, we get to look at the majority of deals in the mid-market and the upper mid-market and have closed 175 transactions since inception. We have a team of 21 and can leverage off the wider ICG investment team, including a further 21 sector-specific research analysts. We sit back to back with Oliver and his team. So over to Con.
Thanks, Mark. And I think actually the relationship that we have with the ICG senior debt team is a really good example of one of the many benefits of the ICG platform for Enterprise Trust. And ICG has a very collegiate culture. We sit next to each other. I think you can tell a lot about the debt markets just from overhearing the tone of the conversations. But you know, the platform advantage we have specifically from having access to Mark and his colleagues, we get tremendous early insights into the debt market. The team have tremendous domain expertise. We're working at the moment on a company which has a very specific business model. It's one of those companies that if I told you what it did, you would know the company. But we've been able to tap into their knowledge and get up the curve really quickly. I think a lot of the time that really helps us as well to screen out deals, because I'm sure it's the case with Mark's team. Some of the best decisions we make are the things you don't see, the things we don't do. And it really gives us too an extra depth with our managers. It really helps us to grow and build relationships with our managers because they see us very much as coming from one organization with similar values and a similar approach. Just before we go on to look at the portfolio, just on the next slide, just wanted to spend a little bit of time looking at debt in the context of the ICG Enterprise portfolio. And I think the main takeaway from this is that we feel that we're very well positioned, both in terms of our leverage levels. So around 80% of the portfolio is levered below 6 times. I appreciate that's very high from a public market perspective, but we feel very comfortable, particularly given the strong the quality of earnings within the portfolio. We've got very good interest cover. That's even with the higher interest rates, the spike that we saw in the last few years. And we have limited refi risk. And I think as Mark has addressed, we think overall the risk from refinancing is diminished, but we have 12% coming up in the next year. So we're very, very comfortable with that. And as I say, particularly in the context of the quality of the portfolio and given some of the characteristics of the companies we invest in, which Oliver has just outlined. I'd like to move on now to have a look at our portfolio alongside Lisa. But first of all, and again, this is one of those many slides where those of you who've listened to us before may have heard this, but I think it's worth recapping on how we access the market. So fundamentally, we're investing in those defensive growth strategies and companies which Oliver has just outlined. We invest in top tier managers. So across the board, those things are common denominators, the quality of the companies, the quality of the managers. But we access them in 3 different ways: primaries, secondaries, and directs. So first up in the primaries, around 50% of our portfolio. You can see from the cash flow profile, this is where we commit upfront to a fund. We have outflows to begin with, and then we have what's called the harvesting period, which kicks in typically at around year 5 as the manager begins to start its realization program. Why do we like primaries? First of all, we get a really strong bedrock of stable returns, strong, stable returns. It's highly diversified, which of course minimizes our risk. And critically, it gives us access to the world's best managers. So by having a primary relationship, it then helps both our secondaries and our direct programs. Now, secondaries, that's essentially, you're going to hear a lot more about secondaries in a second from Oliver. But in very simple terms, that involves buying what was historically a primary fund, but typically as it's approaching its harvesting period, so sort of years 4, 5, 6. Why do we like secondaries? Well, first of all, you can diligence the underlying assets. Remember, in a primary, we're committing up front, but with a secondary, we get to see what we're investing in. We like the cash flow profile, so you can see from the chart on the slide, there's an earlier payback period, and secondaries generate very strong IRRs if executed correctly, if we pick the right assets. And finally, direct investments. Relatively simple. This is where we just invest in one company. We invest alongside one of our existing managers. So we typically have exposure both directly, but also through a fund. And the reason we like directs is that we get very simply to invest more in the deals we like, in deals that really have those very strong defensive growth characteristics. We have a very strong platform at ICG to be able to diligence those assets, and that obviously reduces risk and improves our performance. And co-investments have historically generated outsized returns, and we think that our top 30 assets, which are mostly co-investments, have really strong outsized return potential as we look at them today. So this approach, having these three different access points, we think it's got tremendous advantages, not least of which is that the markets often move in different directions, and at different points in the cycle, primaries, secondaries, directs may have compelling characteristics. At the moment, because of the difficult fundraising environment, which is actually a positive for us as investors, we think that actually all three markets have got really strong fundamentals. And I won't steal Oliver's thunder on the secondaries front, but suffice it to say that, of course, when managers are struggling, all else equal to fundraise, we're able to access better managers. We're also able to access managers in the size that we want to. And it also yields more direct opportunities as managers will put less of the deal equity into their funds and offer more to their investors, both as a risk management technique, but also as a way of being more investor friendly.
Are we allowed to ask questions under the housekeeping?
Where are things, Dave? At the end, please, James. Thank you.
Moving on to slide 27, very briefly, just on the performance this approach generates. This chart shows the split between our primary, our secondary, and our direct program. You can see evidence here of outperformance over those critical 5-10 year periods in our secondaries and directs, which is what we would expect. There is a benefit to being able to diligence the underlying assets and having a more active approach to portfolio company selection. But what really matters, of course, is our total performance. It very much is a holistic strategy. You can see that over the last 5 years, portfolio has generated 19% per annum performance. That's 140% overall. And we are very pleased with the historical performance. We also think the portfolio we have today has got very good potential for the future. But with that, I'm going to pass over to Lisa just to give you some insights to portfolio today.
Yep. So turning to slide 28. On this slide, we want to provide an update on the primary commitments which we made in full year 22, which effectively referred to our 2021 vintage year funds, given our January year end. We're often asked about the performance of our 2021 investments and whether we have any regrets given the macro turmoil which began in early 22, the start of the Ukraine war and rising inflation. I'm pleased to say that those investments are off to a good start, with deployment in line with expectations and current valuations implying a return of 1.35 times net and 23% net IRR, with significant upside remaining. As a recap, we committed to 9 funds, including 5 existing and 4 new managers. The re-up commitments included 2 ICG funds, as well as new commitments to THD, BC Partners, and TJC. We also identified a number of attractive new managers, such as Brigal and GI Partners, with strong track records, differentiated market positioning, and co-investment potential. We often talk about the importance of primaries in accessing co-investment deal flow, and this is evidenced here by the 20 co-investments we were offered from our 2021 vintage funds, of which we completed 10. Move to the next slide, page 29. This provides an update on the performance of our co-investments over the last 2 years. We've completed 11 co-investments, diversified across sector and geography. Furthermore, these co-investments were completed alongside 10 different managers, which demonstrates the breadth of our co-investment relationships. All these businesses are either market leading and or have defensive growth attributes, and are backed by sponsors with deep, relevant sector experience. While still early, the performance looks promising, with an aggregate return so far of 1.2 times net, and all investments are marked at or above cost. To further illustrate the characteristics we typically look for in a co-investment, I wanted to provide more colour on European Camping Group, one of our largest co-investments. Firstly, ICG has a market-leading position as the number one operator of mobile home campsites in France and number 3 in Europe, operating a fleet of over 50,000 mobile homes across 560 campsites, mainly in France, Italy, and Spain. ICG has demonstrated resilience through economic cycles, growing at 5% during the GFC period. Although significantly impacted by COVID, it bounced back quickly in 2021 and has continued to grow bookings over the last 2 years, despite the tougher macro environment, with 2023 bookings up 11% versus the prior year. This has been driven by a combination of price increases, around 8%, and also improved occupancy levels. Lastly, and potentially most importantly, is a deal alongside PAI, one of our strongest co-investment partners, with a strong track record in the sector, having done attractive deals in Roompot and B&B hotels. Since our initial investment in October 21, we've invested additional equity to fund this transformational acquisition of Vacances Select in February 2023, which is expected to be highly synergistic. So to summarise, the investment is marked well above cost, and we expect to generate an attractive return for the trust. Moving to slide 30, this provides a high-level intro to the third pillar of our strategy, secondaries. Again, not wanting to steal Oliver's thunder, so I'll just sort of talk very briefly on this slide. Secondaries are highly complementary to our primary and co-investment programs, with key benefits including access to a more mature portfolio of assets, i.e. no blind pool risk, accelerated liquidity, and PE-style returns with less risk. Over the last few years, we've increased our exposure to secondaries from 13% in full year 2019 to 18% in full year 2024, with a target allocation of 25%. However, given the relatively quick return of capital, growing our exposure has been somewhat more challenging than with primaries or co-investments. So over to you, Oliver.
Thanks, Lisa. Maybe to set the scene on secondaries, a lot has happened over the last decade in terms of secondaries, and the market looks very different today than it did 10 years ago, or certainly very different to when I did my first secondary in 1998. Those days, it was a tiny little market, less than $500 million, and you had to kind of work with the GPs to find the transaction or one of the investors to sell. Today, this market has exploded. It is now 110 to 150 billion in size. And to no surprise, the market has changed also in terms of what kind of transactions they are. And there's a whole plethora of different types of transactions, from the more traditional and classic buying a position from an LP, so from another investor in a fund, so buying a fund position, which is what we call an LP stake, portfolios of LP stakes. More recently, you probably picked up in the press, you see also GP-led deals, which has effectively become a new liquidity channel for the private equity fund managers. So what a fund manager does, if they like a portfolio, a company in their portfolio, and they like to, instead of selling it as an IPO or sell it to the next private equity firm, what they like to do is carve it out and put it into a continuation vehicle and then continue to manage it for another 4 or 5 years. That's called the continuation vehicle, or we call it also GP-led deals. So the market has exploded and there's all kinds of transactions. But the interesting thing is that if you look at the market today, it's still dominated by the big generalists who do everything under one roof. So they do with the same team, the same fund structure, co-investments, GP-led deals, LP-led deals, although we at ICG fundamentally believe that those are very different types of deals and therefore need a different approach to the industry. So what we started about 7-8 years ago at ICG is really rethinking about the market. And we pioneered the secondaries market by being the first ones out there with 2 dedicated teams and 2 dedicated fund structures, pure plays on the GP-led and on the LP-led deal. And that's what you see on the first slide, our approach and our strategy. So, and the ICG Enterprise Trust benefits from this because the ICG Enterprise Trust is invested in both those funds. The ICG Strategic Equity Fund, which is entirely focused on GP-led deals, as well as the ICG LP Secondaries Fund, which is entirely focused on LP stakes. And that's how we approach the market. And that has also created for the Enterprise Trust great co-investment deal flow from strategic equity as well as from LP secondaries. Now, what we want to do today is focus more on the LP secondary side, and why that is an interesting space for the Enterprise Trust to be exposed to, and what we have done here in that market, giving us some a little bit more content around that market. So why do we invest in LP secondaries? Because to our mandate and what we're trying to do as an investment strategy is providing our investors private equity type of returns with much higher liquidity and lower risk. The LP secondaries fits very much that kind of investment strategy. And why? So if you look at the slide below, that represents a cash flow curve of a buyout firm, a buyout fund. And what the LP secondaries, what we try to do as a team is to invest in a fund in year 4, year 5. Why? Because that is the sweet spot when you actually can analyze a portfolio, you understand what's in the portfolio, you have the you can analyze it, you have the data. But at the same time, you're 4 years, so you reduce the risk because you can already see the losers and the winners. And usually the losers are already written down or written off. The winners have been written up, but not to the same extent as you usually see at exit. So, and at the same time, you're 4 years to 5 years closer to exit. So therefore, you're getting higher liquidity because you're 4 to 5 years closer to exit. Typically, you can do the life phase or the investment period of the exit period and holding period of a secondaries, LP secondaries fund is half of a buyout fund. At the same time, you have already the portfolio, you can analyze it, and that's why you have also lower risk. And on top of that, because we're buying portfolio stakes, so LP stakes, it's very diversified. So typically an LP secondaries fund, we will have over 1,000 companies. So it's highly diversified, and there's constant cash flow coming out because every week there's a company being exited or sold. So it is a great way and a great fit for the Enterprise Trust to provide private equity type of returns, but with much lower risk and higher liquidity. Now, looking at the data, does that actually really true what I'm saying? And looking at the data, so we commissioned Josh Lerner from the Harvard Business School. He teaches private equity at the Harvard Business School. We commissioned his team to kind of look at the risk return profile of LP secondaries. He went into the databases of he had access to, as well as some of the other big data banks such as Preqin and Burgess and all that, and consolidated and brought all the data together and looked at the years from 1980 to 2018 and looked at from the risk return perspective. What didn't surprise us is the graph on the left-hand side. When you look at the risk return of secondaries vis-a-vis buyout and growth, you basically get similar returns to buyout, but from a TVPI perspective, but with a much lower risk factor. You're actually more in the credit space from a risk factor, and that is measured by standard deviation in the TVPI between the different transactions in the secondary deals. What did surprise us, how liquid and how fast their capital returns back to investors, particularly compared to the credit space. And that's where you see here on the right-hand side, some of the data. So it kind of confirmed that this is a nice way to play private equity, but with less risk and higher liquidity. Going on to the next page, just a couple of words on the current portfolio. What have we done? We really started with, I joined in 2019, 2020. As many of you know, I've had worked for and built secondary funds for several alternative asset managers. So joined in 2020, 2019, and that's when we really started to kind of focus more on the secondary side, also for the enterprise trust. There are 4 transactions we've done. These were all co-investments alongside the LP Secondaries Fund, or specifically picked for the enterprise trust. And you'll see here, we made our first commitment to the secondaries fund in 2022. That was a 60 million commitment, and then we did these 4 direct transactions or co-investment transactions alongside ICG, the LP Secondaries Fund. You'll see here that gives diversification, so it reduces risk. That gives enterprise trust exposure to 62 funds. It's all in Europe and the US. And you see on the right-hand side, the returns have been very strong out of the gate. And particularly when you look at the DPI, we feel like very good about that the strategy is working. So it gives cash back very fast and creates good liquidity for the ICG Enterprise Trust Fund. With that, I'd like to conclude on the next slide. Then we can open it up to Q&A. I hope you have a good, I hope the presenters in the presentation gives you a good idea that we're very focused on generating private equity returns, but take the volatility and the risk out and improve the liquidity for our investors. And having a dedicated investment team really allows us to actively construct that portfolio. I think the top 30 is a great example in terms of, because with the exception of one company, all of those companies in that top 30 are effectively co-investments that we've done alongside our managers. And you saw their earnings and the strong growth of that portfolio. That shows the strength of having a dedicated investment team to pick deals and actively construct a portfolio, but also shows the benefit we have with the ICG platform, which gives us that background and that connection and interplay with the credit team, with the other private equity teams, and as well as with the secondary teams, generating some good returns out of the secondaries. With that, I'd like to close the presentation.